Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
This episode is based on a webinar recorded in December 2025. Mike Williams, president and co-founder of ClimateFirst Building Solutions, led a panel discussion on investing in building resilience that included Angela Adduci from the BMO Climate Institute, Kathleen Beaumont from the Investment Management Corporation of Ontario, Natalia Moudrak from the consultancy Aon, Holly Neber from AEI Consultants, and ClimateFirst's Olivia Pink. Here's Mike Williams.
The focus of today's session is all going to be around this case study that we recently published. What we do in this case study is really look at physical climate risk through the lens of financial prioritization. We have a panel of experts who contributed to the case study, either as authors, technical contributors, or peer reviewers of the work. Angela, I might start with you. With the Bank of Montreal really championing this case study, I think it's wonderful, but I think it is kind of interesting to think about a bank or a financial institution being interested in this area of research. Can you elaborate a little bit on what some of the drivers were behind sort of the initial thought spark to spur this research?
Yeah, absolutely. Thanks, Mike. I think it's been super encouraging to see the response that we've gotten from industry on this. And I think it really reflects the need that there was for this type of contribution in this space. So really, really encouraged to see this. Like many large financial institutions, BMO has a significant footprint in the commercial real estate lending space. And so at the beginning of this year, we started thinking really deeply about how to take a close look at the intersection of resilience and the built environment, and to especially consider the data gaps and challenges that perhaps stakeholders were encountering that were deterring asset owners or investors from really making those resilience investments, or even in some cases considering them. I think we've seen a lot of high-level statistics around this. Things like $1 invested in resilience results in anywhere between $7 and $13 in avoided losses on the back end. And that's a great overarching narrative to have. But I think when you have conversations with industry, we kept running into this challenge, this gap around demonstrating this payoff on the building level or on the portfolio level, which is really honestly what is needed for many stakeholders to feel confident in moving forward with these types of decisions and to feel like they have that type of fluency, that type of confidence there. So we realized to kind of credibly speak to a broader swath of industry, we really needed to produce research that was going to resonate with how they make decisions and ultimately produce data that speaks to a more granular cost-benefit analysis around the resilience of their own assets. So ultimately, the result was the case study, and I'm really pleased with how it turned out. As a bank, the more resilient our clients are, the more resilient we are. And at the end of the day, we're really only as strong as the communities in which we operate. So there's a vested interest in increasing the resilience of our clients and in the sectors where we operate. And I think the last thing I'll add is that this also strengthens our own understanding of resilience investments and our ability to underwrite these types of investments. So there's a strong potential here for us to improve our understanding of risk and return here and to be more responsive to projects and technologies where clients may find it increasingly necessary to operation in certain markets.
That's fantastic, Angela. There's a lot to unpack there, but I think so many things you said, I think have resonated across this group. Data gaps still in the resiliency space. And I think we filled some of those with this case study, but still work to be done. And then I'm super excited to hear financial institutions starting to think about how you might be able to underwrite some of this risk and enable some of the best practices that we can identify through these types of studies to actually be realized and start to create a more resilient built environment. So very excited for what we've done and even more excited for what may be coming next. I think some of your thoughts had me thinking about Kathleen and her lens as an investor. And when you're thinking about loss avoidance, those can be difficult metrics to incorporate into investment decision making, into the underwriting decisions that you have to try to support, into the capital plans that you have to try to create. Could you share some insights in terms of how IMCO is currently tackling that today, and maybe some things that you see coming down the pipe?
Agree that it is a necessary piece of work that helps kind of capacity build the industry. We need to do this quicker. As we know, there's increasingly more physical risks and weather events that make this type of insight increasingly more important. I think what Olivia said initially in her presentation was around, historically, the commercial real estate sector has relied on historical data and qualitative assessments and kind of have stopped their work at understanding their hazard exposures. And I think that there was a knowledge gap between kind of the climate experts saying this is a big deal and the investment community saying, okay, so what do I do about that? I don't understand what 100 means for fire risk. How do I underwrite that? And so what Mike has said around avoided losses, it is tricky to underwrite avoided losses because every investor's risk tolerance is different, right? And so an avoided loss number is going to be specific to the investor's risk tolerance. What we have seen, though, is much better data coming out, like the work that ClimateFirst does around physical risk assessments and not just quantifying the financial losses, but understanding, better loss modeling, second derivative impacts that can be where we can take the insights and integrate them into our underwriting models. And so if we think about things like insurance cost trends, as an example, we're increasingly more focused on making sure the insurance policies at the asset level are appropriate for the risks that we're taking. Sometimes those portfolio-wide policies that large institutional investors can have are insufficient in some instances. And so we have to think about how we underwrite the insurance costs and maybe the escalation rates we might use in our underwriting. The other big one is capital planning, right? Like how do we thoughtfully integrate the costs associated with resiliency into capital planning, anticipating future code changes or mitigating some retrofit costs down the road. These are the types of things we're starting to think about with the use of better data. We can make better investment decisions. I would argue, though, that we are certainly in the early innings of understanding this information, but this is a really good first start, and it's at least starting the conversation today.
Yeah, no, that's wonderful, Kathleen. And I agree with your observations and your experience in that a lot of these analyses have stopped at the hazard exposure level. And that's interesting to know where you have a problem, but boy, would I ever rather know what I should begin to do to address that risk. That had me thinking, Holly, doing these case studies can also be nice that you get to know some new people. And it's been nice to get to know Holly through this exercise. And that forced me to do some homework and reading into the ASTM standard that she played a key role in leading. But could you talk a little bit about how the industry is moving beyond just hazard identification to getting to more credible climate value at risk analysis that is providing people like Kathleen, people like Angela at the bank, the level of resolution that they need into this problem to start to take next levels of action?
Yeah, I'm happy to be here, and thanks so much for the invitation to review the case study, which I think is, as you guys have said, a great first step to help build capacity in the industry. I think that's the biggest thing we need to see is all of us to become more sophisticated. I think early stages, there was this sense I can just order a report and it'll tell me what my risks are. And then people started realizing there's much more to it. And each of the providers are approaching it differently. So that's where the ASTM standard work really came in. And I think, as you all have said, we're sort of early innings. A kind of equivalent would be the environmental consulting industry, of which that's my background. In the early 90s, when people started doing environmental assessments, it was all over the place, lots of different approaches, lots of different methodologies. And over time, a standard was developed. People started to rally around that standard, and we started to see more consistency to the point that today, when you order an ASTM environmental site assessment, you know what you're going to get. Maybe there's some quality differences between providers and so on, but everyone knows what that's all about. I think we are in early innings of trying to understand what is this ideal scenario reporting for climate risk assessment. And truthfully, it does depend on your use cases, right? So we want to think about what is the use case. Sometimes people are just doing a portfolio-wide analysis. Sometimes they're really trying to make property level decisions, like in this case study. And so really the whole user community needs to become more informed about all the nuances and questions that they should be asking. I think As an industry, I'd love to see more transparency around, to what extent are actual property characteristics being used in the analysis. And I'm not saying that it's not okay to use general property characteristics in an analysis, but I want to have transparency about to what extent that's happening. I'd love to see transparency, and you guys have done a great job in the case study about all of the transparency, but just in general, our industry, more transparency around the accuracy of the geocoding. Is it just a point on a map, or is it the whole parcel? I think in the case study, it was the parcel, really helpful. What are the risk ratings used in the modeling? What thresholds are used to push something from moderate to high risk? I think there's a lot of frustration in the industry that, you could order 3 climate risk assessments and you get 3 different answers. A lot of that's because of those proprietary risk thresholds that they're using. And so we need more conversations around that. We also want more conversations around what are the resources and methodologies used for specific perils. Some, there's a lot of consistency, flood, but others like heat and wildfire, there's still a lot of variation of what resources the modeling companies and the assessments are being used. And just generally, how are uncertainties conveyed? Uncertainty from our climate modeling community, we know that uncertainty increases with narrowing spatial resolution. Uncertainty expands when translating peril to impact, and uncertainty varies by peril. So with sea level rise, we have a very high level of confidence that we can predict that. With things like severe thunderstorms, this uncertainty is a little higher, which is all great, right? Like there's uncertainty in all commercial real estate investment, right? Like you're predicting what the interest rates are going to be. You're predicting what insurance might cost you next year, right? So it's okay that there's uncertainty. Obviously, I'm a huge fan of this work. But I think the more our industry becomes comfortable with that and talking about that and understanding what have we ordered, what are the results telling me, and how much can I really rely on them, that is an important conversation I'd love to continue. And this case study is a great step forward.
No, that's amazing. Like, I agree so much with the complexity that all of your response really alluded to, that all these different models have assumptions built into them, and then you're layering models on top of models, which compounds that uncertainty. And to get people confidence to drive decisions based on these models, I think the other thing that you repeated in your response there was around transparency. And I think someone once told me that a model by definition is wrong. That's maybe a touch extreme, but that's somewhat the reality. You're trying to make a forward-looking prediction, and to give people confidence in that model, you have to be able to explain what it is that's behind it. The other thing you touched on was the accuracy of geocoding. You got to come up to our office and join one of our internal deep dive sessions. I have a feeling that you guys have had similar debates and discussions in your office. But we won't force all the attendees to nerd out on that subject matter with us today. Natalia, a lot of what's been touched on, we've worked a bunch over the years, and you've done a wonderful job being a leader in this climate resiliency space historically across Canada, but in our engagement here, I've learned you've relocated to Chicago. So I'm glad that you're beginning to spread your knowledge and experience there as well. That's wonderful. But could you talk a little bit? I know through your role at Aon, you engage with a lot of different stakeholders across commercial real estate. And while we are beginning to see the first steps of action, what do you see as some of the barriers that are preventing people from really embracing this notion of physical climate risk and really starting to take action to reduce their risk exposures?
Well, I'll join the choir saying this is a terrific case study. Congratulations on releasing that. And I was so pleased to be part of a team who was reviewing the project, and I was raving about it before it was published. I'm like, oh, whenever it comes out, you have to read it. So great work. I think tides are beginning to shift. I think historically we had quite a reactive approach to the problem of extreme weather events, and now it's beginning to change. I think many stakeholders, especially in financial community, are seeing extreme weather as physical risk as financial risk, and it's moving up the strategic agenda. And this conversation is illustrative of that. And at Aon, you mentioned we work with many stakeholders. We're seeing increasing amount of interest in modeling extreme weather risk from long-term investors and lenders. And it's for portfolio management decisions, but as well as for deal due diligence. So every time that a new asset is being built or acquired, what is the physical climate risk that the asset is facing today? How is it evolving in the future? Kathleen mentioned, is insurance sufficient? these type of insights are popping up increasingly now. And I made a note to myself of 6 questions that we're seeing really often now, just to share with the audience. And they include, has the company, invested company, it could be a commercial real estate company, has evaluated its vulnerability to physical risk, both today and into the future, and the future being meaningful in investment horizon, for example. What material risks have been identified, not just for property, but also across people, operations, and supply chains? What would the financial impact be if there was a worst case scenario? And there could be a definition of a worst case scenario. What could be done to mitigate risk? And, we went through this case study in the flood barrier being one option. So what could be done to mitigate risk versus what's actually being done to mitigate risk, and who is in charge of the file in the organization? Who is in charge of resilience, right? That's another frequent question that shows up. And Holly, you said something about uncertainty, and I have heard this a lot. Let perfection not be the enemy of the good, and let's not use the need for perfect data, which we never will have, as an excuse for creative inaction. We have good enough data, good enough models, engineering experts, guidelines and standards that can guide impactful decisions in terms of how to assess the risk and what to do to limit losses. This case study is a perfect illustration of that. So let's get moving and assessing the risk. In terms of the barriers, what I'm seeing, and I'll give one example reflecting on actually workforce resilience question that comes up more and more now, because I think it's perfect illustration of how to answer some of these questions. We need different experts working together that perhaps haven't worked together in the past. And so if you think about a building located in hurricane-proof area or wildfire-prone area, and let's say there was an impact on that community, and some people may have lost their homes, they have to relocate their kids to different schools, figure out temporary accommodations, they're not really being productive or thinking about work too much. They may need assistance such as paid time of work, access to mental health services, maybe financial liquidity. Some organizations are setting up emergency relief funds. But in order to figure out what that workforce resiliency strategy is, you need sustainability professional that has access perhaps to climate data, with HR professional, with risk professional, and finance professionals to answer questions. Where do our employees currently live? How likely it may be impacted by a natural disaster? What do we want to do as an organization to support them? How much will it cost us to support our employees, and answer these questions? I think it's a good illustration of how different expertise have to come together to answer climate-related questions that are complex. And going back to the actual built assets, to get risk out of the system, you really need whole of society approach. And there's different stakeholders that play a role in improving resiliency outcomes. Federal, provincial, local governments must integrate resilience into procurement decisions, building code, zoning bylaws, master planning decisions. We discussed the role of businesses already in understanding risk and figuring out low-cost measures to mitigate it, prioritizing investment to make sure that we are preparing ahead of the disaster striking. Investors and lenders who are not screening for this type of risk need to start screening for this risk. It's financial risk. It's fiduciary responsibility to do that. I think critical that every time we're building new asset, we integrate in the RFPs questions about what physical climate risk this asset will face today, in the future, and ask engineers and architects to answer in RFP responses what kind of resiliency designs they may propose to the owner. Because if you don't ask these questions explicitly in RFPs, Mike, you can comment, you may not receive those answers. So it's a shared responsibility. Different stakeholders have a role to play. And thank you for the leaders on this call who are playing this role quite actively.
Yeah, Natalia, I agree with so much of what you're saying. It's very hard to argue that this is no longer an unknown risk. We've talked on it quite a bit in looking at resiliency here. And I think, Kathleen, you implanted this term of phrase in my head as we were working through the case study, but like we're really talking about value preservation. And when we can make a building more resilient, we can enable it to ideally preserve its value through the next storm. But I think that the next big unlock toward climate resiliency could be to start to find ways to create value through investments in resiliency. Be curious to hear both from yourself and Angela. It'd be wonderful to hear the bank's perspective again, but thinking about that move from protecting that value to finding ways that through these investments in resilience, we can start to create value at building assets.
Yeah, I mean, physical risk can present itself as impacting income and valuation, but not consistently. I think the challenge currently is that market participants may not be underwriting insurability or tail risk appropriately, nor integrating resiliency into capital planning, resulting in mispricing of risks. And when you have that, there isn't necessarily a common language or an appreciation for that risk, which is how you think about building value. Think of it a cap rate, right? And the challenge there is when you have that mispricing or misunderstanding of or inconsistent view of risk, it's hard to see value creation persistently, which is that unlock that we need for commercial real estate investors to invest in resiliency, because they're looking for a return on that investment. And avoided loss, although incredibly valuable insight, and you can use that to underwrite, isn't necessarily a return on your investment. That's where that scenario analysis and tail risk assessments are really important. I think as we continue to capacity build the industry around doing that type of tail risk downside scenario analysis and appreciating what your risk tolerances are as an investor will help unlock investment decisions. And the more investment decisions we see, whether it's through investment in resiliency measures like a flood wall, or potentially avoiding an entire market altogether because that's too risky for them, for example. Once we start seeing those types of decisions being made more consistently and in larger scale, I think we are going to see that unlock of value creation. What I do agree with, though, on how you said transparency a lot, and I couldn't agree more. I mean, we need better alignment and transparency amongst particularly the largest financial players, the insurers, the lenders, and the asset owners. Asset owners need the insurers to say, you're going to get better premiums because of this. And we need lenders to say you're going to get better lending terms because of this. That's hard to do, right? You have large financial institutions trying to work together, and that just takes a lot of collaboration. That's a big barrier that currently exists. But I'm confident that with these types of conversations and, unfortunately, more and more physical damage done to buildings, this type of thing is going to result and bear its head in the financials of these investments, and we won't be able to avoid it anymore. One of the other things that was important that you mentioned, Natalia, was around loss modeling. It's not just physical damage. It's also like there's the community damage, but it's disruption. So if you're thinking about you're an owner of an office building, and people can't come to work, you actually, as a building owner, often in your lease agreements have to give your rent back. Like that's something you can underwrite, right? So I think that there's ways we can think creatively about underwriting downside scenarios that will move the needle and unlock that value creation or at least risk mitigation lens.
Absolutely. I would echo everything Kathleen said and what most of, if not everyone, has said so far, which is that this is just a starting point. My hope is that this research can be a jumping off point for more dialogue, more fluency, more capacity building across all the different sectors that we have represented, even just here on this panel. I think there's a huge opportunity here to bring together the different pieces of the puzzle a little bit more closely. Lenders certainly have expertise, but I think there's room for us to learn from each other in a lot of different ways. And it's ultimately beneficial for the built environment to be more resilient broadly. And in order for that to happen, we need to continue to have these conversations, continue to produce this type of data, and not just understanding the risk itself, but understanding how the different stakeholders speak about it so that we're not maybe saying the same thing, but in different languages, really putting in that work to understand how does insurance speak about this? How would an engineer speak about this? How would government procurement or building code specialists speak about this? I think that is increasingly important as we think about how do we have these conversations and how do we build that muscle up. The last thing I'll add is that Natalia was one of my first calls when we started thinking through this, and that really wasn't by accident. I think insurance just has a huge amount of expertise to contribute to this and also a huge role to play as we think about this moving forward. And I think that there can be a very strong educational role played by the insurance industry to just bring that to the table and help to secure better outcomes all around.
No, that's fantastic work and great reflections. I might throw it back over to Olivia and maybe just bring it back to the case study a little bit. I think some of the work that was done in the case study can help to facilitate or maybe start some of these conversations between the different key actors, from insurers to asset owners to lenders. And maybe if you can just share some insights that maybe spark for you from the case study.
Yeah, no, totally. Thanks, Mike. I think what the case study really highlights, in my opinion, and what it really shows is, and I think this has come up in a lot of conversations that we've had today, is, we need to take this beyond just knowing what the hazards are at a site and knowing what the climate threats we face, and really understanding the true impact it would have on the building at a more granular level, and the need to also put a dollar amount on that. I think even just knowing what the impacts are and the vulnerabilities of a building are, that's hard to take to the table where all these other competing risks are, to talk about the need to invest in it. And by putting dollars on it, it unlocks this ability to talk about this risk equal to all the other major risks that face commercial real estate in general, and also allow you to start making that business case to show and to kind of map out how the dollars you invest into this show a significant impact in your risk management strategy. And I think that applies both to the physical impacts on the building, to the operational downtime, et cetera. So I think, to me, this case study really showed how that quantification and that building level view are two really core things to unlocking some of the next steps and conversations.
We are also seeing, in addition to requests for building level insights like this, more requests on going a little bit wider. So, for example, if somebody is thinking of acquiring a hotel property in Florida, a request would be, what is this building exposed to? What is the potential for property damage, business interruption, expense today and under different warming conditions into the future? But also, will the roads be accessible leading to the hotel property? Will the port be impacted? Will the airport be impacted? Same with data center clients. They're asking not just about the site, but what about the power infrastructure on which you're relying to power the asset? Again, transportation, access to it. So I think the conversation is also evolving beyond property specific to critical infrastructure that the property relies on to stay functional and operational.
Totally points to the one other really core stakeholder in all of this too, which is government, right? And how our different levels of infrastructure governed by, municipal, provincial, in Canada, or federal, the key role they play in this too, right? We're able to, as asset owners and operators, you can control your own property, your building, and what you do about that. But it's really understanding community level too. What are the risks and how are those being managed, and what strategies are in place too? So I think that raises a really interesting and really important point, Natalia.
That's fantastic. Thanks everyone for joining. These conversations are just getting started. If you haven't had a chance, I highly encourage you to download the case study. You can visit climatefirst.net, and the case study is available for download there. With that, thank you so much to our panelists. Have a wonderful day.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening, and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.